Welcome back to another deal of the week breakdown. In this video, I want to walk you guys through a pretty unique deal. My name is Ricardo Carrillo. If you haven't seen my deal of the week videos before, welcome. I run a nationwide mortgage lending team. We help people scale their real estate portfolios for both residential and commercial real estate all over the entire US. We just got Puerto Rico as well, and we specialize in everything investor related. I've been an investor for many years. I have worked with thousands of real estate investors across the entire US. We've done over $500 million worth of real estate transactions. And it allows for me to get a really good bird's eye view on where clients are going for my own personal investing, but it also allows for me to see where my other real estate investors are going and those recommendations that I can then provide to my future real estate investors. Now, in this deal, I want to take you guys through a very similar deal to a property that I actually purchased myself. I have a condo in South Florida, in Miami, Florida. That property, I ended up using a very similar kind of loan program here because what's something that's very unique with Florida specifically and a lot of the East Coast markets is that there's a kind of structure to buildings where there's a lot of condos, right? And a condo building, has, let's say 50 plus units, 100 plus units. They require different kind of financing where you can't go to a local bank like a Chase or a Wells Fargo or a US bank if you're buying in a building that allows for you to rent a property for a shorter term. So anybody who's doing a short-term rental throughout the East Coast or throughout Florida, in most cases, if you're buying in a condo building, we're going to talk about a unit that is considered non-warrantable. Now, non-warrantable just basically means that it doesn't pass conventional guidelines. It doesn't allow for you to get a traditional loan where you're putting like a 5% or a 3% down payment. You have to use a loan program that works for non-warrantable condos. Now, the downside to buying a non-warrantable condo is that the down payment is typically larger. We're talking 20 to 30% down typically. It just depends on the location where you're purchasing, and it depends on the HOA and the condo association themselves. Now, for this specific client, it was a 25% down payment for the condo building where he was purchasing. It was in a city called Panama City Beach, PCB. It's south in Florida, it's just west side of Florida. It's a pretty unique market where there's a lot of condo hotels, which is like this kind of structure: condo, hotel, non-warrantable condo. They have a lot of amenities. Think like a golf course or things of that nature. Can make the financing trickier. It's one of those things that I'm like, hey, if you're going to look at these kinds of properties, you need to be working with somebody who understands what we're talking about. And your real estate agent should be telling you the same thing. If you're talking to a real estate agent and you're wanting to buy a condo that's a non-warrantable condo, they have to be advising you in that way. The agent on the deal needs to know that this is a non-warrantable condo because they're just different kinds of financing. There's a lot of different rules that can come up. This property was pretty massive. It was 3,300 square feet, and it was a 3-bedroom, 3-bath. So this property was a condo. Not too many people that purchase condos. I actually like a condo. I mean, I think the condos are cool, and they're unique. You can do different things as long as the other people in those units, you just design it a different way, just the same way that I did my condo in Miami. The loan type that we did on this was a non-warrantable, non-conventional loan. So non-warrantable is the condo type, warrantable, and non-QM or non-conventional was the type of loan program that we used because traditional banks won't do it. You have to work with a different lender. We actually underwrite those loans in-house. We work with a lot of real estate developers in South Florida specifically, where we'll come in as the preferred lender on the development project. And we work with a developer who's doing, 600, 700 units in Brickell and in Miami, and they're doing, a massive project. And we'll come in as a preferred lender. We'll work with them. We'll facilitate the financing for all of the end buyers that buy those units. And so our team is honestly, we're one of the best experts in non-warrantable condo hotel loans, condo buildings that allow for Airbnbs. So almost every building that allows for an Airbnb, it's going to be considered non-warrantable. This property was on the market for 32 days. Appraised value on the condo came in at condo value, which is at $455. Now, the beauty of this is that condos are typically cheaper, right? So this is why people sometimes want to purchase condos, because most condos are cheaper. It depends on, of course, where you're looking. And if we're talking penthouses, we're talking millions of dollars potentially, depending on location. But condos are typically cheaper, and that's why some people tend to go towards condos. Now, you can still purchase a condo and put a low down payment. I'm not saying that you can't. I'm just saying that if you're buying in a condo building that doesn't qualify for conventional financing, then you're gonna have to go with one of these loan programs, and that just ends up being most buildings that allow for Airbnb. Now, down payment was at 25% down, which ended up coming in at a $113,750 amount of what we were paying for down payment. Interest rate on these programs are typically a little bit higher than conventional financing, I would say, but because we're doing such large down payments, normally you get better pricing. So there's like a law of diminishing return with down payments, which means like the more that you put down at some point, it doesn't really make sense, right? Like it's going to go like this in terms of like value based on how much money you're bringing. This is kind of like a graph or like a circle. You'll see like you put more of a down payment, you get a better return, and then it kind of comes down in terms of like you putting a larger down payment. It doesn't really make sense. And that's typically 25% down. When people are putting 25% down, you're not going to be making more money on your return if you decided to do 30 or 35 or 40% down. At that point, it doesn't really make sense for how much savings you have on the rate. We ended up coming in at a 7.25% interest rate, which was, I would say, relatively close for the market of when we were buying this property. Principal and interest payment, so just the part for the actual loan itself, was $23.27 with 93 cents. Now, $23.27 with the 93 cents, that's just principal and interest. Homeowners insurance came in at $174 with 73 cents. Property taxes came in at $319 with 90 cents. And then there was no PMI, since non-conventional loans actually don't carry any PMI at all. HOA, which is important for any association, any condo building, was $9.98. And that's typically an indicator. One, Florida condo hotel fees, condo HOA fees are just so expensive. But number two, if it's a higher HOA, it's probably because they have other amenities or something else that they're offering that makes it so that you're paying such a large amount of money, you know? The total monthly payment ended up coming in at $38.20 with 56. So $3,800, which is actually relatively close to the payment that I have on mine. Total monthly payment on mine. Total closing costs came in at $30,486. Now, I would say that this is higher than what we typically see, and that's just because of the cost that we had for the interest rate, as well as just like time of the year of when this person was purchasing the property. It makes it a little bit trickier. And it was just more money out of pocket, right? So like the deal really has to make sense. It has to be a good return on investment. And specifically this client, one of the strategies that we were using was benefiting from doing a cost segregation analysis where we're saving money on taxes. We're able to write off more. We're able to use the short-term rental income and offset with his losses and his business and other stuff. So, you know, it's always one of those things where we want to be paying attention to the whole strategy, not just the property cash flow, making sure it makes sense. Like the majority of the time, my investors that are purchasing these different kinds of deals, it's because of the fact that they know, hey, I got to think about the strategy behind this and like the long-term play. How many years ahead am I going to be saving money on this? And then also, how much money am I coming out of pocket with? And can I do something else with that money? Those are kind of the conversations that we'll have when we're thinking through what kind of deal to really look at. $3,800 was adjustments and other credits. So adjustments and other credits are basically when you're purchasing a property, the seller has to pay some sort of property taxes. The buyer has to pay some sort of property taxes. It just depends on the time of the year. It's typically like a credit to the seller or a credit to the buyer. And then total out of pocket on this ended up coming in at $140,000 with 425. 76. Bam. 140,000. It was a pretty significant amount of money that we were putting out of pocket. This client expects to see great returns on this property. I mean, like I said, majority of my investors, they're using different tools to run the numbers on rental income, to look at projections, to look at what the appraiser says. So we're looking at multiple avenues. We want to make sure that the deal makes sense. And I always say, if the numbers make sense, then the deal makes sense. I hope you guys found this deal of the week informative. It was a little bit different because, like I mentioned, loan programs are always just different. It always depends on what route we're taking and, you know, whether or not the strategy makes sense. And in this situation, you know, there wasn't a lot of wiggle room that we can make towards saving money and finding ways that we can limit the out-of-pocket cash. So it ended up being more money out of pocket, but, you know, it'll be a profitable deal for our investors and they'll be able to continue to purchase more real estate. So if you haven't seen my other deal of the week videos, I appreciate you guys sticking around this long. Please like and subscribe. You guys can check out my other deal of the week videos right here and right here. I will see you guys in the next deal of the week. Peace out.